Hello and welcome to Macro Pulse. The biggest macro risk this year to the US economy has been that of stagflation, the fear that growth will slow down while inflation is rising. And if we look at the most recent data points, we see indeed that there are some signs that the economy is slowing, but we're not yet seeing any evidence that inflation is rising. And remember, this stagflationary risk is really a result of the tariffs that was announced and the tariff uncertainty that's still permeating in the market. But let's look at the growth side. From a growth perspective, we are seeing that monthly job gains are slowing, that the consumer has lost some confidence, that the housing market is deteriorating, and more recently, last week, we had the retail sales in the US. We saw that on a month-to-month basis in May, retail sales dropped by 1%, and the auto sector was particularly weak, dropping almost 4% on a month-to-month basis. Now, this may be because we've seen a lot of front-running over the last few months, and now we're seeing the reverse taking place. And this is happening more broadly in the economy as well. Food services, which is a good indicator of discretionary spend, has also been fairly weak. But while we see softer growth data, we're not yet seeing any evidence that inflation is accelerating on the back of the tariffs that was announced. If we look at the CPI numbers that came out last week, we saw that both headline and core inflation at 2.4 and 2.8% is still above the 2% target. But if we look at the 3 months, the most recent 3 months analyzed, we see that both of those two are now printing below 2%. So the current run rate of inflation is actually still coming down. It's too early, however, to celebrate, because we still believe that due to the front running that we saw over the last few months, that there could be a delay in when these tariffs would start and have an impact on prices. Also, we think that corporates at this time still may be able to absorb some of these price increases. And let's not forget the fact that the conflict between Iran and Israel is also presenting another stagflationary risk. The risk that the oil price may spike higher, causing inflation to rise later this year. And also, due to higher inflation, it's typically bad for the consumer and it may hit global growth as well. Let me say a few words on the current conflict. This latest attacks between Israel and Iran is very different to the ones that we saw in 2024. We believe that there could be more damage and it might take longer for this to be resolved. If we looked at what Israel said, they said they will continue with these attacks until the Iran nuclear threat has been removed. And the only way that that nuclear threat could be removed is by either Israel completely destroying Iran's nuclear capability, a regime change in Iran, or the US and Iran finally striking a new deal or a new agreement. We think these scenarios all carry some complexity. It may take time, it may require more damages or losses, and it may require the US to get involved. Thus far, the US has threatened to get involved, but has still showed that they prefer an agreement. But we think the likelihood of the US directly getting involved has increased. And with that, the probability that we may see a supply disruption in the oil market. Now, fortunately, there's a lot of surplus or spare capacity in the global oil market, about 7 million barrels per day. But it may take some time for that to get onto the market as well. So in the short term, we could see some risk that the oil price may spike if we see a further escalation and the US start to get involved in this war. Therefore, it's not a surprise that the Federal Reserve believe that a wait-and-see approach is the best way in conducting monetary policy. And so last night we had Jerome Powell kept rates on hold at 4.5%. He did state that the uncertainty that's currently out there has diminished slightly, but it still remains high. And to reflect these risks, they've trimmed the growth outlook from 1.7 to 1.4%, and they've increased the inflation forecast, the core PCE forecast, from 2.8 to 3.1%. The dot plot still shows that they expect rate cuts twice this year, so bringing down the policy rate to around 4%. On the local front, we've seen that growth has also been revised downwards. We started this year with a consensus expecting a growth rate of 1.7%. At the moment, the consensus is expecting about 1.1% growth in the South African market. But let's not forget that the economy is not the market. If we look at the JSE, the equity market is up almost 10%. The fixed income market, local bonds are up about 5%. And even the rand has strengthened thus far this year. So while growth outlook remains weak in South Africa, we still see that there's opportunities in the SA equity market. For instance, gold miners, platinum miners are up more than 50% this year, and Naspers is also up more than 25%. And so we think these securities or sectors has been quite defensive in this current macro environment in which we find ourselves. However, there are some positives. We still continue to see that inflation remains benign and remains low. The most recent print shows that inflation sits at 2.8% on a headline basis, which means it's below the lower band of the target range, and therefore there's still some scope for the SARB to continue to cut interest rates. Our view has been that there could be another cut on the 31st of July. However, with the risk of increase in the oil price, we may see a delay in that decision. From a retail sales perspective, we also had some positive data. We saw that on a month-on-month basis, the retail sales came in about 1% higher, and over a year basis, about 5%, which means the consumer may be lacking some confidence to spend, but they're in a good position and ability to spend. Other local good news has been that the Financial Action Task Force, or FATF, have announced that South Africa is now adhering to all 22 requirements for us to be taken off the grey list. And so we expect an announcement later this year, maybe by October this year, that South Africa would be taken off the grey list. For now, the market, however, is being held hostage by the fact that there's a conflict between Iran and Israel, and therefore we propose to remain cautious, although there's still some opportunities around, and we may be able to find some opportunities in the coming volatility. Thank you for watching.